Hi, everyone. This is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. He is president and CEO of Alpha Financial Technologies. He predicted the 1987 stock market crash and profited handsomely off of it. He has been a professional and successful trader for over 45 years, and he's even worked for big-name investors, including Leon Cooperman and George Soros, and he's the author of some really well-respected books on trading, including Methods of a Wall Street Master and Principles of Professional Speculation. Victor Sperandeo, thank you for joining me.
Pleasure. Nice meeting you.
Now, Victor, I want to ask you about your piece from February that you put out, and I'm going to attach a link to it in the information section of the interview so our listeners can read it later. So your title of the piece was, Has Debt Hit Its Tipping Point? So do you think that debt has hit its tipping point for emerging markets?
Well, for emerging markets, which have declined substantially, I would say yes, because it's basically based on the rules. There's no changes there. So yes, debt is an issue for Europe, emerging markets, and even Japan to a degree.
And you told me in emails, because we were discussing this before we booked an interview, that your views have changed a little bit and that you're going to come out with a new piece, I think, in the near future. And you told me that you think deficits don't matter. Do you think that's just for the United States then?
Yes, that's just for the United States for now. Again, it's all based on rules. Now, let me just give you some context here. In early February, when the market fell or peaked in January 26th and fell, and we learned that the deficits were going to be in the area of $1.2 trillion this year, ended in a few weeks, and then $1.8 trillion next year, when you combine that the Fed was going to be selling part of their portfolio. So the new debt that was going to hit the market, a man that talks about this often is David Stockman. And the fact was that I asked the question, because of this debt that was now being, expanded through the next 10 years, which the CBO report came out. It comes out at the end of January, the beginning of February. And it showed this approximately $1 trillion a year in deficits through the next 10 years. Now, that does not include a recession. They do not have a recession in there, which is, of course, absurd because we haven't had a recession in 110 months. But the fact is that when you have a recession, if you look at the last recession we had, which was 2008, and you interpolate the expansion of the deficit from the last recession, which is a good guide, it's going to be about $3 trillion a year, not $1 trillion for 3 years. So you can see that these numbers are astronomical and they're out of sight. So I asked the question in my February piece, is it time to think that debt has hit its tipping point? Because, of course, debt has never been an issue for quite some time. Now, as time has gone on, I have noticed, and this is where my change of mind comes in, that the yield on the 30-year, which last night closed at 3.10, had not moved up. And I was curious as to why, if my thesis was correct, that debt has hit its tipping point, which was the implication of the article, at least to me. And I said, well, who's buying these bonds? And I've discovered that the commercial banks were the primary buyers of the new debt. Now, let me put this into just one little piece of historic context. When the Fed started to raise rates in this cycle, which goes back to December the 16th of 2015, they went from 0 to 1/4. On the 16th, the close, the yield on the 30-year was 3%. Now, after 7 increases, including the first one, it's 3.1. there's something wrong. You see, nothing acts like that. There is some change somewhere. So when I saw that basically that debt was being bought by commercial banks, I said I had to find out why this was the case. Now, by the way, I say this as with a smile. If you try calling the Federal Reserve, any Federal Reserve, I called two of them and asked them some questions, which I'm going to pose to you and explain to you about why this phenomenon exists. And very few people understand this or realize it because they didn't do the research. The point is the central banks will not talk to you. So if you ask them the questions I'm going to pose to you, they will not give you the answers because they don't want you to know. And the key is to why debt is not crumbling and yields going through the roof is because banks change the rules for themselves, approved by the Fed, on how they pay for the debt, as well as they mark to market the P&L on the debt they're buying. So let me pose this to you, or rather than play the game of posing, I'll just explain to you. Right now, there's an account, and this was widely changed and accepted in 2014. So this has been going on for a while. It's called the hold to maturity account. So if you're a bank, a commercial bank, and you buy a Treasury, a sovereign debt, you can put it in this hold to maturity account, HTM, and you do not have to mark to market. So there is no losses. Doesn't matter how low the price of bonds go, you have no losses as long as you have it in that account. Now, there's the other account, the normal account, which most banks have used, is called available for sale, AFT. So if you have bonds in that account, yes, you have to mark to market. But all of this, and if you do the research, you'd see that banks are obviously moving their bonds into this hold to maturity account. Now, when a commercial bank buys a bond, it does not have to put up any reserves. Zero. There's no reserves. There is no, as I said, mark to market. And if you look at the Basel rules, which now we get to capital hits, sovereign debt is exempt. So they have no capital hits. So now where do they get the money? Well, it's a loan to the government. Now, if you understand Banking 101 in your fractional banking course that you define fractional banking 101, they just write a check. They print the money into existence, just like the Fed would buy bonds and effectively issue a check, and that would be how they pay for the bond. So they put up no money, they collect the interest, they have no reserves, they have no capital hit, and they have no mark-to-market losses. It's an arbitrage. So you can fund, if you're the government, you can now fund an unlimited amount of debt. All you want, because every time a bank buys a yielding sovereign debt, it's arbitraging the interest with no money up and no risk. Who wouldn't do that? Hard to believe, but if you look it up, if you go do the research, you'll find out why this exists. So, I mean, to read the Basel III takes some time, but you'll see there's no capital hit. The simple answer is there's no capital hit. So they don't have any capital hits to their sovereign debt purchases as long as they buy government debt. Now, this doesn't apply to corporates. It only applies to government debt.
That's very interesting, Victor. Very, very interesting. So in terms of, I know you've traded many different markets. You were around during the tequila crisis and the Asian tiger crisis. So basically, if some of these government bonds that the large banks are holding go bad, the banks don't have to mark the losses to market. They don't have to write them off. They could either pretend that the losses didn't happen, or they could go to, I don't know, the Federal Reserve or the U.S. government and ask for a bailout, because that's what's been happening in past banking crises now for the last couple decades, right?
Okay, yeah, that's a different issue, however. I'm only saying, just to be clear, this only applies to U.S. government debt by U.S. commercial banks. And I don't know the rules around the world. I mean, in other words, if the ECB bought a U.S. sovereign bond, what the rules are for them, I'm not sure of. But the key is, when you're now not talking about bailouts anymore, because bailouts are different. Now, this, as I say, only applies to government debt. If a bank chooses to buy uh, Asian debt or other debt, the rules are different. The rules are different as I just described them without me repeating myself. There are reserves, there are capital hits, there are all those things that apply. So it really makes these commercial banks focus on, why would I buy those when I can just buy the U.S. government debt and just make the 3%? That's why I say, you think about it, there's been seven rate increases since the 15th of December 2015. Yields were 3%. They're 3.10 as of last night. They're up a tad today. They might be 3.11 or 3.12. But you see what I mean? That's impossible.
Yeah, the yield curve. The Fed wants the yield curve to steepen, right? So they want the short-term rates and the medium-term rates and the long-term rates to go in a steepening curve, but that's not what they're getting, right? The rates instead on the yield curve are flattening, and they may even at some point go inverted.
Yeah, that's again, we have to really realize that the world has changed. And that used to be the case because they wanted the banks to make money. And of course, if you have a flat yield curve, banks can't borrow cheap and lend dear. So right now, it doesn't matter because the banks can buy the 5 years for, 260-ish, and they just make 260 and they don't put up any money and they have no capital hits. It's far more profitable. Believe me, what they're doing now is far more profitable than the banks. So the banks are not going to not make money. They're going to make a lot of money. And the more debt that the government effectively needs to borrow, it will be sold. Now, I'm not saying that rates won't go up a little bit, meaning from 3.10, and obviously you want to buy the one with the biggest coupon, right? Because you're getting the most interest, and the losses don't matter. It's not like you have risk. You have no risk. So you buy the bond with the highest yield. But I'm not saying yields can't go up to 3.20 or 3.25, because if certain events occur, yes, they'll creep up there, they'll move up, and then all of a sudden the banks will be looking to be buyers on with the higher yield. Again, they don't have any issue with the ones they bought before because there's no mark to market.
So, Victor, do you think the markets in general, whether it's the stock market, the bond market, other markets that you've traded, do you think that right now markets compared to the past are not thinking about the long term and not adequately pricing in or discounting certain risks?
Well, it's the only simple answer is things are different. If I were the trading I did when I was, let's call it starting in 68 and really going into the 90s, and I sort of switched hats and started to develop trading algorithms, but those days are gone. There is no trade. There's buy on dips, and there's hold, and then there's buy more on dips. But there is no trading. There's no way to make money on the short side unless you're a stock picker and some earnings are going to be bad. I'm talking about the markets as a whole. They don't go down. They just go up. And we've been in a bull market. It's a historical bull market. So I just want to pinpoint that if I were a quote unquote trader, a day trader, which I used to do, I don't think I could make a living in this market. It's a completely different venue because it's all manipulated. There is no free reading the tape, so to speak, markets. So with that said, just so you understand my background here and point of view, right now there's a buy the stock market and hold and maybe trade around a few issues. You can trade a few of the techs and you sell this one and buy that one. And if Facebook is going to have a problem, you sell Facebook, add more Amazon. The point is that right now, with the stimulus of the tax cuts plus the deficits, the stock markets are going to do fairly well, and they have done well, and they've done well because of zero interest rates up till the point that Trump was elected. So you had a 4% growth quarter, 4.2. The Atlanta Fed, the last reading, they have the new one today, was 3.8 for this quarter we're in now. And they change it today, so I don't know what it is. As they usually do it after the market closes, so it's out, but I haven't looked at it yet. So, but it's going to be in the threes. And if they get a year over year, which I believe they're going to get, of over 3, that's the reason stocks are doing so well. Now, there's no guarantee that stocks will continue to do well. It depends on the outcome of in two things. And this is important because these are the risks going forward that are the highest rated risks in my book. And that is that the tariffs that Trump is negotiating with primarily China don't start to have an effect. And he in this case knows he's got the leverage. I believe he's going to win the tariff war. I believe that everybody has to buckle because U.S. is the biggest buyers in the world, and you can't not change things if we say you do this, otherwise we raise your tariffs. There's nothing you can do. So I believe he's going to win that war, but I'm not sure. Okay, that's the risk. The other risk is the election. If the Democrats do win the House, then we will go in recession. And I traded in 74, and just to give you some perspective, OPEC put an oil embargo on in 73. The S&P was down 15%. Nixon had his issues and was going to be potentially impeached. In 74, it started in March. The market was down 26%. And that's because when you have an unknown in government, in this case, the president, the investors go to the sidelines. They do not buy. That was a great short sellers market in those days. And I did really well shorting every time the market rallied, and it was like printing money. But in this case, the same principle applies. If the House impeaches Trump, and I believe that the Senate will remain Republican, but even if it's not, he will not get impeached unless there's a crime. And so far, there is no crime. So he will not effectively, tried by the jury, lose the impeachment case. He will win it, but that doesn't matter. What matters is that once you start this process, he's doing nothing but defending himself. The focus is all on this political process. Nothing gets passed, nothing gets done, and investors see this and they start to sell stock and they go to the sidelines and they go to T-bills. That's basically why you will get a recession. And that's why Trump, I don't think he understands or appreciates the potential risk he has with this Mueller hoax. And I believe it is a hoax, but he calls it that too. But there is a huge risk there if it proceeds, because if the House is lost, and, you know, the polls are all showing that the House is going to be won by Democrats. I don't believe in polls because they're all made up these days. So, but right now I'm just saying if, and it's very possible that the House could be lost. And if it does, his presidency is over. You go into recession, and it will be a horrible recession.
So do you think a lot of what the events that you just described, do you think that this reminds you a lot of the 1970s then, or is there another historical reference point, maybe similar to the Great Depression of 1929, some of those examples are? Because it seems like if the Congress goes into gridlock, which you said is a pretty high probability, then there's going to be maybe high taxes. The tax cuts are going to get negated. There's going to be misallocations of capital. And then there's going to be we're already seeing evidence of increasing inflation too. And if the high taxes get levied with the trade war, we're hearing some companies are reporting that their costs are going up. Do you think that that's going to be stagflationary then going forward?
Okay, no, I didn't say any of those things, and I'm going to repeat. The key is the House is lost. There's not going to be any tax increases. He wouldn't sign that into law. Neither would the Senate. I don't believe the Senate, with all the House, if you will, races that are going on where so many Democratic seats are at risk and a very few Republican seats. So in my view, they're going to pick up seats in the Senate. Let's assume I'm right on that. But even if they didn't, he's not going to sign a tax increase into law. So it's not about tax increases. It's about the end of anything that right now the House and Senate can do to improve the status of the economy. It'll be over. And that's what happened in 74. That's why I gave you the perspective. OPEC oil embargo, you're down 15%. Nixon tapes, you're down 26%. You see, because again, there's an unknown. We knew about the oil embargo. Okay. Once it's declared, you know about it. What did the government do? It basically monetized it. It basically did not want people's incomes to be devalued. So what it did was it expanded the money supply. It printed money and everybody got a lot of money, and you had 9.6% inflation compounded throughout the 70s. And it was an inflationary environment. GDP was extremely high, a lot of it inflation. The key was that in this case, it's not about changing laws. It's about not enacting new laws, and it's about the unknown. If you're going to impeach Trump, and whether you like him or you dislike him, it doesn't matter. His personality is irrelevant to the economy. His personality doesn't matter. People develop likes and dislikes, but that doesn't matter. If he enacts policies that help business, and certainly a 40% corporate tax cut is huge, this is beneficial. But if you have an unknown where nothing new is going to come into existence because of the nature of the House now being Democratic and don't want him to succeed, it's the end. It's over. So that is a huge risk. And you should focus on that risk, because there's only one example, and that's the one with Nixon. It showed very true that the economy deteriorated greatly, not from the oil embargo, but from the fact that nothing new could get through Congress because Nixon was defending himself and there was no new legislation.
So let's talk about the dollar now. The dollar has had a pretty strong rally against the G7 there in the dollar index since March, and also against emerging market currencies. It bottomed around 88, tested support there for a while, and now it's rallied. It got to a little over 96 temporarily. When we're recording today on Friday, September 14th, it's at 94.96. So do you think this dollar rally is going to continue? And if it continues, do you think it's going to do a lot more damage to emerging markets and other countries?
Well, certainly if it continues to rally, it will. It'll be terrible for the rest of the world, especially emerging markets. But here's the big but. Right now, the inflation is in the high twos if you use the CPI. It came in at 2.7, it was 2.9. So inflation is increasing, and the Fed is still raising rates. They're going to raise rates in the September meeting, so it's going to go up for the 8th time. That's almost a guarantee. It'll be up a quarter. So if the market starts to not like that increase, meaning it starts to be affected, and in my view, it's going to be affected not because of the increase, because you still have negative real rates. It's going to be affected because of the potential loss of the house. So the markets will start to act poorly, and I think the Fed will back off. So my vision is that after this increase, the dollar will start to sell off in a slow, steady way, and there'll be talk that there'll not be another increase this year. That's my 2 cents. Now, Larry Kudlow's a big dollar kingist fan, and I'm sure he's a part of the reason that the dollar is being held up. But I think that it is killing the rest of the world. There's a lot of pressure on the U.S. to stop the rate increases. We're the only country in the world that's increasing rates. So I think that that it's going to end, and I think the dollar is going to go down. I'm not short the dollar yet, but I'm looking to get short depending on this meeting, and what the Fed says.
Yeah, because if you look at a lot of other stock markets, all the other major economies, their stock markets are below their 50-day and 200-day moving averages. So that kind of reminds me from a financial history perspective of the couple years before the October 1929 crash, because all those other major economies were in recession or depression, and tons of flight capital came here to the United States. And we're kind of seeing that similarly in the charts, because the other stock markets in other countries are not doing well and the U.S. stocks are doing well.
Correct. And then remember that the other countries are not using fiscal policy. They're not lowering taxes, which is the primary reason their growth is slowing and it's being adjusted downwards. But all of what you said is true about 29. Of course, we were raising rates from February of 29, and that was a big part of the reason that what you said was accurate and caused the crash when when it was time to come, coupled with the tax bill that came the following year, and then of course the Smoot-Hawley bill. But neither here nor there. Your thinking there and mine are the same.
So in February, we had volatility return to the stock market and other markets, and the VIX had an enormous spike, I think over 60%. It blew up some leveraged VIX ETFs, and a couple other ones just closed. Are you surprised that there hasn't been a lot more volatility, or do you think that's kind of the new normal now?
No, I was not. When you went down and then you formed your horseshoe bottom, down, up, down, I was saying was still potentially in a bull market. So I didn't go short. I traded a couple of times when I thought it was a sure thing, and won most of those times. The key here is that you're in a bull market. The fiscal policies have really kept this bull market going. Began with monetary policy under Barack Obama, and now continues on the fiscal policy with Trump. So, like I say, the risks are really the House victory, and or if the Fed keeps raising rates, that's an issue. I look at this as the last rate increase this year, and I think they're going to use some language to temper for the next quarter, the Christmas quarter. They're going to temper their language. That's my assumption. But if they continue to raise rates, that would also be another risk.
And if the Fed keeps raising rates, I mean, if you look back through the history of the Fed rate hikes into the 2008 financial crisis, it eventually broke something.
Yes.
So if the Fed keeps, and Paul Volcker raised rates, kept raising rates, and eventually it broke something. So we'll see if they continue on the same path.
Correct.
So you said that you designed some high-frequency trading algorithms. Now, these things have gotten very, very complex. There's hardly any human beings doing much trading on the New York Stock Exchange floor anymore. It's a lot of if one of our listeners goes out and visits the New York Stock Exchange, there's not as many human beings anymore. Do you think these high-frequency trading algorithms now are manipulating many markets, and it's much tougher to trade as a human being than in the past because of these programs?
Well, yes, just to clarify, we create trading algorithms, but not high-frequency algorithms. We mainly create trend-following CTA-like strategies using commodity futures primarily, but nothing high-frequency. High-frequency is really a front-running game. And basically, if you trade in size, yes, trading in size is a difficult deal because these front runners see what you're doing and they front run you, so you're giving up some of the profit. So that is a problem. And why it's allowed, I don't know. I mean, these people are obviously connected and they keep the game going. but it is a detriment to day traders, and it basically is a detriment to anybody who trades in size.
And it seems, in the stock market rally, because we did have a dip in stocks, that a lot of this rally has been on very low volume. And in a lot of markets, Victor, it seems that, these high frequency trading algorithms, the claim that they're sold to the public and the regulators is that they provide liquidity. But it seems that in a lot of markets, there's a lot less liquidity now.
Yeah, I concur. It is all light volume, and it's mainly buy and hold. It's not by institutions. It's not and or hedge funds, meaning I'm going to buy this position and I'm going to hold it, and I'm going to short that position and I'm going to hold that. So it isn't. It's mainly the light volume is because there's very little real trading, because you don't have the volatility, because you are manipulated markets as such.
So years ago, you gave an interview for King World News, and you said that the U.S. could potentially have hyperinflation. Have your views changed about that?
No. The one thing, there are a few things, like Aristotle spoke about the laws of logic, and in this case, the end game is absolutely, now the end game is hyperinflation. The governments are not going to allow a deflationary period again. Lehman is the last deflationary downturn you're ever going to see. They learned a lesson. So anything that when the market is going down, they're going to have a tendency to print money and or give it out. This universal income, basic income, is going to lead to hyperinflation if it ever comes about. But it's kind of like the reparations. If you're giving people money, they're gonna spend it, and that's where you get your inflation. And we don't have inflation because the QEs didn't go to the average guy. They didn't go to the public. They went to high-end investors who didn't spend the money. They reinvested it. So that's why you don't have inflation. But the key is the end game is definitely going to be inflation. Now, the key question to that is when, and unfortunately, I don't have an answer for you. When is the key, and I can't answer that. But I can tell you what it's going to be.
Yeah, we have the everything bubble now that hedge fund managers are calling it, because a lot of that monetary inflation that's been created since 2008 by all these different central banks a lot of it has not gone into the real economy. It's gone into all the different asset markets instead.
Right. When you pay $500 million for a painting, you can bet that the inflation is in the real estate, art world, equity markets, certain bonds. It isn't given to the people, the public. And so if the public doesn't have the money, they can't spend it. They can go into the credit card debt, as they have, and there's a point where they stop.
Exactly. And they're paying, some people are paying $50 million for a brand new artist that don't have any reputation and stuff. So it sounds like they're just throwing money away.
Right. Well, if you're a billionaire, that's not a lot of money. but there are many billionaires being created today. By the way, Atlanta Fed shows a 4.4% growth for this quarter. Not that they've been wrong. I'm only saying psychologically, a lot of people look at them and therefore they weigh what they say. So if they're talking about another 4.4 quarter as of today, now that changes, but that's the projection they gave today. See, that's going to keep the markets strong. It's going to keep them up. And really the markets also believe that Trump is going to win this trade war with China, that they're going to cave.
Well, we'll have to see about that. I'm not sure if anyone wins in a trade war other than, small selected like special interest groups, or because it looks like American farmers are really taking it on the chin right now.
Yeah, well, we got to look at the end result. He would say to you that he's going to demand reciprocity, and that's how it'll be. In other words, we'll not put as much of a tariff on your goods, but you've got to buy our goods. I mean, that's what he's negotiating for, so that there's an equality of the trade deficit. He doesn't want to see those trade deficits anymore. So it depends how it plays out, to be honest. That's what you got to look at.
Well, the rest of the year is going to be very interesting because in the last month, the U.S. government spent $433 billion in spending. And you did talk about hyperinflation, but it looks like the emerging markets are the ones that are in the most trouble. So in the short term, the dollar may go up, but that's going to cause even more pain. It's going to cause like a feedback loop that's going to potentially vicious cycle and hurt the emerging markets even more. But long term, I think the U.S. has immense problems here with the budget deficits and all the other problems and the long-term liabilities.
Except I just spent about 10 minutes explaining to you why in the short run, budget deficits don't matter. They'll be sold. So in other words, they get financed. In the longer run, it's a different issue, but because I can give you scenarios where it will matter. But there is no budget deficit issue. Now, they can sell the bonds. That's what counts. So a guy like David Stockman, who I respect and a very intelligent guy, I have all his books, he's dead wrong. He's not a little wrong. He's dead wrong. There is no deficit problem. There is no budget problem. Those bonds will be sold. I just explained to you, if I was a bank, I'd buy $1 trillion right now.
Yeah. And Victor, there's also a ton of flight capital that's coming in from Europe and China and emerging markets into U.S. markets. So they have that money too to buy treasuries as well.
True.
Well, Victor, I really enjoyed our discussion. I think our listeners are going to like your insights there about the banking system. If our listeners want to follow more of your work, maybe check out some of your books and follow some of your trading articles, how did they do so?
Well, I've got a website. I don't really put a lot on it, to be honest with you. Now and then I'll write an article when something strikes me. So, you go to, my Tradovic website, but I don't actually put a lot of what we're talking about on there unless I have an intellectual question like I did in February about, is this a tipping point? And since then by the way, I wrote another article about what we just discussed that was printed by Epic Times, and then it was taken over by Breitbart Hedge. So I basically say what I've said is out there in print if you wanted to look it up.
Okay, so I'll attach a link to that in the information section as well. Thank you for your time today, Victor. And it's going to be very interesting to see what happens over the next couple months because it'll be political fireworks there, and we'll probably have more volatility in the markets if the Democrats do win back a lot of seats in the House.
Correct. That's what you want to watch because they want to stop Trump, and they're afraid of him, not because of his personality. I know a lot of them don't like him, but it's mainly his policies. They are panicked that everything he's doing is going to work. So that's really the issue.
And then they're going to lose political power then?
They'll continue to lose power because they've really, with the Supreme Court nominations, I mean, there goes another major nail in the coffin is his ability. And if you look at Ruth Bader Ginsburg, she was recently on TV the other day. She didn't look good. So he may get another pick before this term is over. So, I mean, that's the issue. They're losing power and they're not going to be able to gain it back. So for them, the House is critical.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.